Thank you all for joining us for the Building Owner Meets webinar. This is Rob Harmon. I'm the director of the Meets Coalition. My intention is to run through the PowerPoint. That should take somewhere between 20 and 25 minutes, which will leave us a good half hour or so for Q&A. With that said, I'm just going to jump in. As most of you know, I assume MEETS is the metered energy efficiency transaction structure, and I'm going to be talking here today about how MEETS was designed to help building owners make their buildings more profitable when they're engaged in either better design for new construction or retrofits of existing buildings. So I'm going to hop right in here. In my view, and in the coalition's view, deep energy efficiency in buildings is necessary, but is currently not scalable using existing transaction structures. And there are many reasons for that. The two most fundamental ones are that deep energy efficiency undermines the utility business model, and the split incentives destroy the economics on the real estate side. So I'm going to go through the utility economics very briefly. I think it's important for folks in the real estate community to understand the utility's perspective on energy efficiency, and then we'll get much more into the juicy part about how MEETS was designed to help the real estate community. So from the utility perspective, think about this graphic. This is the California power mix, and what this graphic shows you is how California met its energy needs. This is back in 2011. There's a similar graph, I'm sure, from more recently. But what it shows you is that a big chunk of the California power mix was met by energy efficiency. And I think most of us would agree that's a good thing. Here's a very similar graph for the Northwest, Pacific Northwest. And you can see load growth there over time and how much of that was met by energy efficiency. So again, I think many would believe that that's good news, but if you're a utility CEO, that energy efficiency represents red ink. Utilities earn money on the investments they make, like generation, and so traditional energy efficiency appears to them as negative sales, lost revenue, and lost investment possibility. So simply think about an apple farmer being asked to sell fewer apples. Just on the face of it, you can see how that would be a problem. The result of that is that utilities are going to resist energy efficiency, and particularly at depth. What they do is what their regulators ask them to do, and they generally don't do more than that. There are a few exceptions to that, but that's generally the way it works. In fact, utilities can't really let energy efficiency scale without changes to policy. So in my view, if we want to make these buildings deeply energy efficient, we have to do that through a transaction structure that recognizes the limitations of the utility business model. So those are the utility economics. I'm also now going to jump right into a more deep dive on the building owner economics. All of this is going to be old hat to you, but I just want to run through it anyway. As you know, building owners are asked to make these investments to improve the efficiency of their buildings. In non-owner occupied buildings, tenants keep the savings. And the result of that is the short-term paybacks we see if we see any activity at all in the commercial building space. None of this is new to you, but it is a serious problem in terms of getting depth out of these buildings. I'm going to show you this in graphic form. So if you think about this graph as a retrofit, and a retrofit provides some energy benefits, you can see let's say 100% of those benefits are being tracked on the vertical axis. So that's the savings available at commissioning. And then the horizontal axis is time. You would think that if one implemented an energy efficiency upgrade of a building and you maintained that well over time, the way you would if you installed a wind farm and maintained your wind farm, you would get this big blue block of savings. Rather than thinking about that savings in terms of energy units, think about that savings in terms of dollars. So that's the available cash flow, let's say, from a retrofit of a building that is well maintained. We all know, of course, that that's not what actually happens. What actually happens is this. Measures are installed, and they are, for a variety of reasons, not maintained very well, and they degrade over time. So every utility regulator and every utility has a graph like this. They build into economic models, as I'm sure do many ESCOs and many building owners. So this is just the reality we face, and there are certainly exceptions to this, but this is certainly the majority of the cases. In a non-owner occupied building, the savings that are available to monetize are this red line down here, which would be none. This is the classic tenant building owner split incentive problem. Unless a building owner can figure out how to extract that money from the tenants, they have no available savings, and all they get is whatever the incentive payment was at the beginning of the transaction. So that's not a very investable proposition. Even in owner-occupied buildings, if you look at the residential sector, the average home ownership is 5 years. So if you ask a homeowner how long they're willing to invest in energy efficiency upgrades, they will do so for the length of time they believe they will own their house. And this, you see this in the numbers that you get back from McKinsey studies, et cetera. The average homeowner, of course, has already owned their house for 2.5 years. So they want their money back in 2.5 years, which is why you see 2.5-year paybacks in all of those studies. On the commercial side, the average length of ownership is about 9 years. So again, you look back at McKinsey and you see a 4.6-year payback as the average for commercial buildings that actually do anything at all. So those are mostly owner-occupied buildings where, again, commercial building owners are saying on average they will own the building for another 4.5 years. They want their money back. So those are all rational economic decisions. There's nothing wrong with the way people are thinking about this. The problem is that because of these split incentives, the remaining portion of that blue area is never capturable, and therefore people don't invest in that remaining savings. So you don't see investments that get us deep in the building. So this is just math, and it's rational economic thinking. And it is the natural outcome of the transaction structure that we use for energy efficiency. That's not the transaction structure we use for all other forms of energy, which is a developer and a PPA. And the result of all those other transactions, all those other energy sectors that do this differently, is that you capture all of the energy benefits. So at a wind farm, an outside investor invests and they maintain that equipment and they sell the output of that to the utility. And that's the kind of capture that you see in every other sector of the energy space. You do not see it in energy efficiency because we don't transact on energy efficiency this way. And the way we transact on energy efficiency causes these kinds of split incentives. So MEETS was designed to capture all of that savings in the way that we do it in every other kind of energy sector. So I'm going to show you how that works. Before I do that, I want to touch on a couple of other legal and accounting issues that are important to the commercial building sector. One of them is that, of course, ESCOs are a liability on the balance sheet. So that's not ESCO's fault. That's just the way the stuff works. If you're in the building and you're expecting a payment from the building owner, that's a liability on the balance sheet that the owner is responsible for. That is not helpful in the way building owners move through the world. So there are many ESCOs that are very good at addressing that problem, but nonetheless, they're still a liability on the balance sheet. Equipment leases are accounting problems. Are they operating leases? Are they capital leases? People have been gyrating around this for a long time. There are serious issues associated with this. It is a challenge for the industry. Again, that's not anybody's fault. That's not anybody doing anything wrong. That's just the way it works. Both are a serious problem for building owners at a point of sale. They want those things resolved before point of sale. All of that leads to, of course, shorter term paybacks. Another issue, of course, for building owners is that in terms of their own capital, is that they often have other uses for capital that are more important to them. So that causes problems on the financing side in some circumstances. So those are the basic problems we're trying to address with MEETS. So in our view, the first solution is to make energy efficiency just like generation. Treat it in the same way you treat the energy benefits from a wind farm. Transact on them that way. And I'll show you the way that works. The first thing you have to do is you have to meter it efficiently and accurately over long periods of time. That's what we do at wind farms. That's what we do everywhere. And then you need to buy it and sell it just like generation. We also think an essential piece of this is to use traditional real estate energy tenancy standards for building improvements. This is a big departure from the standard ESCO model. So I'll get into that in some depth here. Step one here is energy tenancy. I want to tell you how that works. Think about an ESCO and think about, we call an ESCO in this structure an energy tenant. An energy tenant will move into a building and they will improve the building in the way that ESCOs would naturally improve buildings, but those are all done through the energy tenant mechanism. The energy tenant pays for those upgrades. Because those upgrades are at the energy tenant's cost and not at the building owner's cost, the building owner balance sheet impact is zero. You've paid nothing as a building owner, so your balance sheet impact is zero. But as in all tenant improvements, the improvements belong immediately to you, not to the energy tenant. So that energy tenant is no longer a liability on your books, and the energy tenant is not leasing equipment to you. This is an important distinction in the transaction structures. So I'll get in a little bit more to how the financing piece of this works and how the cash flows work, but it's really important to recognize that the upgrades to the building are done through tenant improvements. The energy tenant will be receiving in a MEETS transaction a stream of revenue from the utility, and they pay a portion of that revenue to the building owner as rent. So just like in all tenancies, you have a tenant move into the building, improvements are made that belong to the building owner, and the energy tenant is selling a product, in this case to the utility, and paying you revenue. So again, this is modeled on the way wind farm finance works. You have a developer who creates an energy product or an energy project, sells benefits to the utility, and shares a portion of those benefits with the landowner in the form of rent. This is another important distinction. Any party can be the energy tenant. ESCOs are an obvious energy tenant. You can do this with special purpose vehicles. There are building owners who want to be their own energy tenant. There are some models where the utility would like to be the energy tenant. That relationship is very flexible. It was designed, of course, to allow different parties to play whatever role they'd like to play. Importantly, if the building changes hands, the energy tenancy can continue or be bought out. So again, think about a wind farm where a developer builds the wind farm and the landowner is receiving rent as a portion of the agreement with the utility. And if the landowner wants to sell the land, the wind farm continues to operate and will now pay rent to the new building owner or the new landowner in the case of the wind farm. So again, this is modeled all on the existing structures in the energy space that we already know scale. That's the way the accounting works from the energy tenancy perspective. Another crucial piece of this is metering. This is the meter at the Bullitt Center. This is an energy efficiency meter operating there. It's been operating there now for about 3.5 years. The way this works is there's a baseline created based on prior use. In new construction, it's based on a code baseline. We could get into that in some significant detail, probably not on this call, but in a new building, you use a code baseline, and in an existing building, you use the existing conditions baseline or the state of the building prior to retrofit. You can maintain and calibrate that baseline over time. That tells you how the building would have behaved had the building not been upgraded. So that red line and the dots that are close to it are the modeled baseline and the adjusted baseline. The green dots are the actual utility bills. The gap between that, the purple shaded area, is the difference between how the building would behave and how the building actually behaved, how much it consumed. And the difference is the metered energy efficiency. That meter was accurate at Bullitt within 1%. So the meter works. It is a transparent mechanism. All parties can see how the math was done. There's no black box. And it's adjustable for both routine and non-routine changes in the building. So again, we can get into that in some detail, perhaps not on this call if we don't have time, but the metering is in use there and working. This is an energy efficiency statement for the Bullitt Center. The oval on the left is the adjusted baseline. That's that top number. The center oval is the utility meter, or actually in the case of the Bullitt Center, all of the energy use in the building. Some of that comes from the solar array. And the result of subtracting the utility read from the adjusted baseline is the amount of metered energy efficiency that month. So 57,000 kilowatt hours of metered energy efficiency. Very important that that result is in energy units, because once you have a meter reading in energy units, you can transact. This is a key important element of MEETS. You need a meter read to do this. I'm going to walk you through the transaction structure. Really important to recognize that MEETS is a structure. It's not an incentive. It's designed to use the savings value that's currently given away to tenants, the split incentive economics. That savings value is often worth 4 to 20 times the incentive value. In the case of Bullet, where this is happening, the net present value of the power purchase agreement for MEETS is worth 8 times what the upfront incentives would have been worth. And I can show you a little more about that later. In higher energy price markets, where there are many of those, you would see an even larger gap between the value of the incentives and the value of the MEETS contract. As I said, the energy efficiency is metered against that dynamic baseline, and it's sold not to the building owner. This is a really important distinction with MEETS. It's sold to the utility under a long-term power purchase agreement. That's a negotiated arrangement with the utility. The utility then takes that same meter read, in the case of that bill I showed you, those 57,000 kilowatt hours, and places them on the building's common area energy bill. It's in energy units at retail rates. So it's just like the building having a second meter. The traditional meter reads energy generation that was sold by the utility to the building. The second meter is the energy efficiency meter, which is also delivered in units at retail rates. That's how you eliminate the split incentive problem. The building's paying for delivered energy efficiency on its energy bill. So this is similar to on-bill finance, but it's not a finance transaction, it's an energy transaction. Unlike on-bill finance, if the energy efficiency in a MEETS deal isn't delivered, then there's nothing to pay for. You're not in a place where you're paying a finance charge for equipment that isn't delivering the results. It's a simple energy transaction. It's just like all the other energy transactions in the market for traditional energy, right? A wind farm generates benefits, people pay for them on their retail bill. A MEETS contract generates energy benefits, people pay for it on their retail bill. Same thing. As I mentioned, the MEETS charges are placed on the common area bill for a building. The building owner then allocates the costs for that in the same way they do now. Most commercial buildings have a common area energy bill, and it's split up in CAM charges. This would be the same as that. There shouldn't be a need to renegotiate leases and all of those other things with tenants. The tenants are simply paying their share of the common area bill. To show you this graphically, here's the energy tenant who has this long-term rental agreement to harvest the metered energy efficiency. They pay for and maintain the improvements in the building, and they pay rent the way any tenant does. The building owner has a more comfortable and valuable building, and they simply pay the energy bill, which is very similar to the bill they would have paid without the retrofit. In fact, it should be the same as what they would have paid without the retrofit. The tenants have a more comfortable and highly productive building, and all they do is to continue to pay their energy bills the way they always have. So there's no additional cost to the tenants. They simply pay the bill they would have paid anyway, and they get a much better building. Going back to the utility economics, the utility maintains its unit sales and its gross revenues. The utility reads the dynamic baseline meter, and they pay the energy tenant under a long-term power purchase agreement for the energy efficiency harvested from the building. That cash flow is what the energy tenant uses to pay the investor back. So as I said, the building owner in this case can play the role of the energy tenant if they would like to, can also play the role of the investor if they'd like to. I want to walk you through some of the economics. This is the Bullet Center. Traditionally, they would have been paid $84,000 upfront for their energy efficiency improvements. So obviously an upfront payment has a net present value of $84,000. It's about $1.68 per square foot. Under MEETS, they signed a $1.22 million PPA. Based on their discount rate, that has a net present value of $740,000, or nearly $15 a square foot. If you move the bullet center to a market with 15-cent energy prices, you're likely to get about the same upfront incentive in a traditional transaction, but the net present value of your MEETS contract would be $1.6 million or $32 a square foot in the case of bullet. Needless to say, the delta between what a building owner is likely to receive in a traditional transaction and what they're likely to receive in a MEETS transaction is substantial. Some people have asked me about MEETS and PACE. So I put this little table together. The issues here are on the left that we're trying to address is to try to get energy efficiency at depth, which PACE is also pretty good at doing. One of the questions is, has it addressed the split incentives? In MEETS, the answer there is yes, assuming the tenants pay the energy bill. With PACE, that's true, assuming the tenants can pay the property taxes. Is there new revenue for the building owner? Not traditionally with PACE. With MEETS, there is in the form of the rental payment we've discussed. Do you need senior mortgage holder sign off? In most cases with PACE, that's the case. I know there are some workarounds that are being worked on there. Because MEETS is simply an energy transaction, there's no senior mortgage holder sign off. Do you have a viable counterparty? Yes. In the case of PACE, you have the taxing authority as the counterparty for the financing, and with MEETS, you have the utility. Is the energy efficiency metered? It's not traditionally metered in PACE, but there's no reason it couldn't be. And metered EE is part and parcel of MEETS. What's the transaction type? In the case of PACE, that's a loan. In the case of MEETS, it's an energy sale. And then the final three are specific to utilities. My big concern about PACE is that it doesn't solve the utility problems. They still have unit erosion, they still have lost gross revenues, and they don't necessarily get any load management benefits from this because it's not targeted and it's not always metered. MEETS addresses those problems for the utility. And in my view, that's going to be necessary if we want this to scale. Because as I said earlier, you can't take all the commercial building stock in, say, downtown Seattle and you can't use PACE because you can't use it in Washington at all. But could you? If you could, then you can't go and reduce energy use in those commercial buildings by half and not do serious damage to the balance sheets of the utilities. MEETS helps address that problem. This is my last data slide summarizing the building owner benefits there on the upper right. There's a new long-term tenancy in the building, paying rent. That's a new revenue stream for the building owner. You've increased the building value at sale. You don't need to use the building owner's capital, and the building owner doesn't need to be in the energy business. You've also used traditional tenant improvement mechanisms to paper all of this, and I think that's going to be really helpful to building owners as well. On the investor side, you have financing based on a utility PPA. That's a very common financing mechanism. You have a very strong counterparty there with the utility that gives you lower and rated payment risk for the investors. They're very well understood instruments, and you can scale these through aggregation. So the investment community is very interested in seeing MEETS roll out at some scale. I've already walked through the utility benefits, so I won't go through those again. And the society benefits are pretty straightforward. I won't take up time on this to go through those. That's the end of the formal part of this presentation. My contact information is there. You're welcome to contact me by phone or by email if you have additional questions. What I'd like to do now is to open it up for questions and see how I can be helpful to folks individually. So,
hey, Rob.
Yes.
This is Cindy Overby.
Hi.
Hi. So I have a question on if the tenant moves out of the building and there's some vacancies in the building and the energy usage, the energy profile changes, what then?
That's where the metering comes in. So if you have a change in occupancy in the building or a change in use in the building, you will need to adjust the baseline because lack of use of the building is not energy efficiency. The meter will pick up the drop in occupancy because the energy use in the building will fall. And that's a flag for communication with the building owner to determine why the energy use fell. And if there's a change in occupancy, then you need to adjust the baseline down. And so the amount of metered energy efficiency being transacted on would also go down.
Okay, and then to pay off the upgrades, then that would fall to the building owner?
Well, that depends on, That's a terrific question. Thank you, Cindy. That depends on how the arrangement is made between the energy tenant and the building owner. So I imagine McKinstry, for instance, you have to work these sorts of things out in your arrangement with the building owner, where the building owner is compensating you for the energy savings you're generating in the building. So what we anticipate will happen here is that building owners and energy tenants will come up with some sort of shared arrangement for what happens if the building owner can't keep the building occupied. Obviously, the building owner is the person who's losing the most revenue from a lack of tenancy, because the rents are a much higher portion of the cash flow for anybody than the energy savings is going to be. So the building owner will be motivated for a whole variety of reasons to fill the space. But I anticipate that energy tenants and building owners will need to work out an arrangement where, if the building owner is unable to keep the building operating, that there's some compensation flowing back to the energy tenant. But that will be up to the parties to negotiate. That's not a necessity dictated by the transaction structure itself. One of the things I like about MEETS is that it allows those parties to negotiate those things in the way they'd like to. Another example of that would be that at Bullitt, because they have very, very aggressive goals inside the building, the Bullitt Foundation, which is in the middle of the MEETS transaction, compensates the tenants if they hit their energy targets. So the Bullitt Foundation has essentially taken back some of the split incentive issue as a way to motivate good behavior. That's perfectly acceptable in a MEETS transaction. It all depends on how the parties want to negotiate that.
Okay.
Other questions?
How much does the utility charge, this is Cindy again, how much does the utility charge to do the M&V or to any part of the realized savings in the billing of that realized savings?
The way we think about it is the same way, again, that you would think about it at a wind farm. There's a negotiated rate for the power purchase agreement, and the higher that rate is, the more depth you're going to get in the building, right? Because that's just the cash flows. In my view, the utility should have an agreement with the metering company in the same way that the utility has an agreement with Itron, that owns the meter on the side of a wind farm. The utility should have a relationship with the metering company to pay for the metering. It's third-party metering. And they should subtract the cost of that metering from the PPA payments to the energy tenant. To me, that's the most obvious way to mimic stuff we already know works. Whether that's the way individual utilities choose to do it or not is unclear. That we're having those conversations right now. But to me, when you want to change something as deeply as MEETS changes energy efficiency, you want to model it on something and change as few things as possible from the model that we know works. So I'm sure that utilities will come up with other ideas about how to do this. My hope is that we do it in the simplest way possible. There'll be a negotiated rate for the PPA that will be approved by the regulators, and the costs of the M&V will be deducted from the PPA. Other questions? Well, thank you very much for your time. Let's be in touch.
Thank you.